Trading the market can certainly be a cool and potentially lucrative game, but it undeniably carries its fair share of risks. With over 20 years of experience as a trader, I have picked up some valuable lessons, I think, often the hard way, that have shaped my trading strategy. In this video, I will share with you my top 10 scalping rules, which I believe have been instrumental in my success as a trader. As we all know, scalping is a game of speed and precision. It's about making several trades within a session and gaining small profits that add up over time. By nature, this approach will have both winning and losing trades. Now, a good scalper understands this and does not get upset over losses, but views them as part of the game. But here's a little twist. Scalping isn't necessarily about trading a lot. It's not always about quantity, but more about quality. Even a couple of well-selected trades can actually leave you closing your trading day with a nice profit. The real trick is spotting those high probability plays and grabbing them whenever they pop up. So while scalping can be fast-paced, it's also about being selective and strategic. Understanding this concept brings us to the first rule in scalping, which I believe is perseverance. And here I would like to highlight the significance of why sticking to this rule is so important when trading. Like I always say in my videos, trading isn't a fast track to easy money. It's about putting in the time, having patience, and constantly working to get your head around market trends and fine-tuning back-tested strategies. Think of time, patience, and perseverance like the three main building blocks of trading. They are really important if you want to succeed in the long run. And just like anything else you are learning, trading has a learning curve too. We all know that we all mess up and lose sometimes. It's part of the game. But if we keep trying, even when things are hard, we learn from the rough patches and become better at trading. That's why sticking with it can make such a big difference when it comes to improving your trading strategy and reaching your goals. And yes, trading takes emotional grit. Markets can be a wild ride, causing stress and letdowns. But again, staying the course helps us keep our eyes on the prize and not get thrown off by temporary hiccups. That's why in my book, perseverance isn't just nice to have in trading, it's a must. It's the backbone of the mental, emotional, and practical side of trading and paves the way, in my view, for consistent wins. So having that ability to push through, it's definitely a must-have in this game. Rule number two is what I call baby steps. For starters, it mitigates risks. Now, starting with a small daily goal can limit potential losses as you navigate the learning curve of trading. Most beginners, when they start trading, aim to earn $200, $500, or even $1,000 a day right off the bat. But this goal isn't realistic. Consider this: you haven't even made your first dollar, but you are aiming for hundreds or even $1,000. My advice: start with small, more achievable goals. Confirm that your strategy works, and then gradually increase your targets to $25, $50, and then if you do well in this range, shoot for $100. It's important, guys, to take it slow and steady. Remember, it doesn't matter how big or small your account is. Without the right strategy, you are going to lose money. And I do know you don't want to hear this, but the reality is markets can be volatile, and even the most experienced traders face setbacks, as they cannot obviously anticipate every fluctuation with certainty. Also, the baby steps approach provides room for learning. Allowing yourself to start small gives you the chance to learn about different trading strategies, market trends, and key technical models without the stress of risking a large amount of money. Another important aspect of the baby step rule is the development of emotional strength. By starting small, you are more likely to build emotional resilience, an essential trait, obviously, for a trader. I think that it's easier to handle losses on smaller trades, which can prepare you for the emotional challenges of larger trades in the future. So starting small in trading isn't just about limiting risks. It's about creating a measured approach that can lead to raking in green on consistent basis. Rule number 3, strategy formulation. Now, the first premise of this very important rule is take the time to understand the ABCs of trading, things like stocks, forex, futures, and all that jazz that comes along with it. Once you have gotten that down, decide what market you are interested in. Start with one, get to know it well, then explore others if you want. Now, ask yourself, what do I want from trading? This could be anything from making a certain profit each month, or just learning more about how markets work before you start trading them. Once you have this part sorted, start thinking about choosing a scalping strategy. You could opt for price action, which uses raw price movements for signal identification. Alternatively, range trading might suit you. It basically involves trading on rebounds from support and resistance levels in sideways trading markets. Obviously, it is important to select a strategy that aligns with your style and goals, while also providing you with a competitive edge. Next, sketch out your game plan. This includes knowing when to get in and out of a trade. That's your entry and exit points. Next, you need to set some goals. How much profit are you aiming for? And equally important, at what point do you call it quits to avoid major losses? That's your stop loss level. Another thing to remember is that trading isn't just about making money, it's about managing risks too. So you need a game plan for that. With a solid trading strategy, you can keep your emotions in check and stick to a disciplined trading routine. Also, before you dive in with real money, give your strategy a test run with a demo account. This way, you can see how it holds up in different market conditions without risking a dime. And another thing here, and this is key in my view, always keep an eye on how your strategy is doing and tweak it if needed. Remember, trading is a bit of a roller coaster. There is always some risk involved when you're part of it. Day trading, guys, is like a game of chess. At least that's how I approach it. Just like in chess, you need to understand the board, know when to make your move, when to retreat, and how to protect your king. In this case, your capital. So only trade with what you can afford to lose, and hang in there while you find your winning strategy. Trust me, once you find it, it makes things a whole lot easier. Rule number 4. Set clear targets and stop loss levels. When I talk about setting targets in trading, it's not all about chasing the cash, it's also about playing it smart with risk and sticking to your game plan. Think of setting realistic profit targets as your friendly reminder to pocket some cash when things are going your way. And speaking of being smart, let's not forget about stop loss orders. They are like a safety net, super handy, and if the market, for whatever reason, decides to throw a curveball at you, these orders are there to say, that's enough, and help you cut your losses before things get messy. Obviously, not every trade is going to be a home run. You win some, you lose some. The trick is to have those profit targets and stop loss orders in place ahead of time. I think they are like your trading GPS, keeping you on the right path, making sure you don't get lost in the heat of the moment. So bottom line, it's all about being wise, not getting caught up in the greed, and sticking to your discipline. That is the secret sauce to trading smart. Rule number 5, never risk more than 1% on a single trade. Imagine this, you are a trader and you've got, let's say, $10,000 in your trading account. Now, adhering to this rule of never risking more than 1% of your trading capital on a single trade means that the maximum you should risk on any given trade is $100. Sounds small, right? But here is why it's a smart move. Trading is obviously a game of probabilities. Even if you've got the best strategy in the world, losses are inevitable. That's just the nature of the market. By risking only 1%, you are making sure that even a string of losses won't wipe out your account. Let's say you hit a rough patch and have 5 losing trades in a row. If you are risking 1%, you've only lost 5% of your account. But if you were risking 10% on each trade, well, you'd be down 50%. This rule also helps you keep cool under pressure. Knowing that a loss won't devastate your account can help you trade more pragmatically rather than making rash decisions out of fear or desperation. And here's another thing. Trading is a long-term game. The goal isn't to make a quick buck today, but to grow your account steadily over time. By risking only 1%, you are giving yourself the chance to stay in the game longer, learn from your experiences, and improve your strategies. So while risking only 1% might sound like you are being overly cautious, it's a golden rule in my view that's all about safeguarding your cash, keeping those nerves in check, and boosting your shot at earning a steady income from the markets. Rule number 6, stick to your rules. If there is one thing I can't stress enough about trading, it's discipline. You see, you can just wing it and expect to become a trader. It just doesn't work that way. Trading is like running a marathon, not a sprint. It requires a tremendous amount of discipline, patience, and restraint. Imagine this, you are on a winning streak with 5 or 10 green trades under your belt. You're feeling like you are on top of your game, and then comes all of a sudden a single trade that goes south. If you've been lax about your stop loss limit because you are riding high on a winning wave, that one losing trade has the potential to wipe out all your previous gains and possibly your entire account. It's like building a house of cards. One wrong move and the entire house comes tumbling down. And here's another hard pill to swallow. Becoming a successful trader isn't going to happen overnight. It's a long journey filled with learning, making mistakes, and growing from them. You have got to be ready to commit to this journey and accept that it's going to take time. And another thing here, successful traders are like seasoned hunters. They show immense restraint, patiently waiting for the right moment to strike. They don't just jump at every opportunity that comes their way. Instead, what they do is they wait for that perfect set of circumstances to align before they make their move. So the discipline you show in sticking to your trading rules is what really is going to make you stand out from the swarm of average traders out there. Rule number 7, control your emotions. Emotions are like the wild card in trading. They have this uncanny ability for sneaking up on us, and before we know it, we are making decisions based on a gut feeling or a fear rather than hard facts and analysis. Think about it this way. We have all experienced the intense fear or that rush of greed at some point, right? And then there is that infamous fear of missing out, which is always part of a trader's routine. You see a stock spiking or nose diving, and suddenly you feel like you need to jump on board or you'll miss the boat completely. But here's the thing, these emotions, while totally normal, can seriously cloud your judgment. That's why keeping emotions in check is so crucial when you are trading. It's not just about making quick trades, it's about making smart trades, guys. And that requires a good deal of emotional discipline. So how do you achieve this state of emotional control? Well, by not chasing trades and only taking ones that meet your criteria. To do this, you need a solid trading plan that outlines your entry and exit strategy. Obviously, if things go south. I think that this plan serves as your roadmap, and sticking to it can help keep emotions in check. Trading is as much a mental game as it is a financial one. So keep your head cool, stick to your plan, and don't let those emotions run the show. Rule number 8: larger gains and smaller losses. This rule is all about risk management, which is a simple but powerful concept that can make or break your trading game. The idea is to look for trades where the potential reward outweighs the risk. Think of it this way: if you are risking $1 to potentially make 3, you are setting yourself up for success. Even if you lose a few trades, the winning ones can still keep you profitable overall. This is what it's called a positive risk-reward ratio, and it's a crucial part of trading. But how do you achieve this? Well, it starts by understanding the market conditions, studying the trends, and evaluating your entry and exit points carefully. This will help you set pragmatic profit targets and stop loss levels. Remember, guys, the idea here isn't to win every single trade out there. That's not realistic. The goal is to ensure that when you win, but when you lose small. This way, you'll be able to sustain your trading over the long term, even when you hit a rough patch. Rule number 9: understand market structure. As you already know, market structure refers to the patterns of the market as a whole. It's about imbalances. It's about knowing if the market is in the accumulation phase, markup phase, distribution phase, or markdown phase. These different phases or stages can develop into a range of recognizable patterns which play a major role in your entries, particularly if you are focused on price action. Think of it this way: if your strategy is designed for a trending market and you understand market structure, then you know that it is best for you to stay out of the market if it's moving sideways. The idea here is, if you don't know market structure, you're likely to make poor trading decisions. This can obviously lead to losses and missed opportunities. Rule number 10: know your trading style. You see, there is a certain truth in the phrase "nothing beats experience," especially when it comes to trading. You can read all the books out there, attend countless seminars, or even get advice from the best of the best. But at the end of the day, nothing will give you the same insights as making that trade yourself. And that's because trading isn't just about numbers and charts. It's also about emotions and decisions under pressure. When you make a trade yourself, you're not just observing the market, you are actually actively participating in it. And that's a whole different ball game. Moreover, each trade you make, win or lose, helps you understand your own trading style and risk tolerance better. You start recognizing patterns in your decision making, your reactions to wins and then losses, and even your gut feelings about certain setups. So everything that is part of these pictures will help you out. And again, all of this hands-on experience can help you refine your strategy and identify higher probability trades. Remember, and as I already mentioned, successful trading isn't about making a lot of trades, but about making the right ones. And if you want to know more about how to pick out those quality trades, this next video is going to show you how to do just that.